And hello, and welcome to bananacrystal.com. My name is Holly, and I'm here to teach you how to earn dual interest. What I'm going to do today is first take you through the About Earning Dual Interest program. So showing you the benefits of having your money work twice as hard for you. Then we're going to go through the Earn Dual Interest Calculator, where I'll actually show you how you can use the Banana Crystal site to calculate what your dual interest earnings could be. So let's get started. If you're on the Banana Crystal site, what you'll first do is go under the Earn Dual Interest tab and select About Earning Dual Interest. Earn dual interest is a really neat strategy that allows you to have a earning potential of the same capital working for you in two places at once. We've coined it becoming a dual interest banker, the wealth building, wealth preservation strategy banks and the super wealthy don't want you to know. But we're here to tell you about that today. This strategy is a very well-known strategy that has been used by many wealthy families such as the Rockefellers and the Disneys. But we're here to make it feel and become more of a reality for anyone that wants to learn about becoming a dual interest banker. Essentially, what we're going to use is a very well-known, but maybe also very misunderstood product using the chassis of life insurance. Now, before you run away, there is absolutely a practicality to using life insurance when designed properly that can allow you to earn interest in two places at once. So let me show you what I mean by that. Life insurance is one of the oldest financial strategies in this country. Believe it or not, it actually predates the creation of the IRS, which is why it has so much tax favorability due to the fact that it has predated the IRS, thus doesn't have that the restrictions of certain accounts, maybe such as a qualified retirement plan or the restrictions of a 401k, for example. So let's look into this a little bit deeper, shall we? So using section 7702, which is the IRC code that regulates life insurance, you are actually able to design the plan to where the death benefit is minimized to the IRS allowable minimum and the cash value can be maximized up to the IRS allowable maximum, creating a cash favored corridor inside of the life insurance vehicle that is not only liquid to you, but also very tax advantaged and grows very similarly to a Roth IRA type tax benefit. So let me show you how we would do it and also discuss some of the benefits of the plan itself. So let's say, for example, that you had $200,000 in your dual interest bank and you needed to take out $100,000 for an external investment. Let's say you're a real estate investor and you know you can buy a property and that property will cash flow you, let's say, a 15% return every month. So you're happy, right? You've got that money deployed in the real estate investment, making that 15% return. But here's where it gets really cool. If you were to use a dual interest bank versus a regular bank account for that same transaction, instead of having the remaining $100,000 in maybe, say, a Wells Fargo bank account where you're making 0.001% on that account, because as we know, banks really do not pay very good interest rates at this moment. You could actually have the same transaction conducted out of your dual interest bank, and that $100,000 loan would be out on the street making the 15%, but the account balance would actually remain undisturbed. So let's say you got a 10% return, which is highly possible with these types of plans we design. You'd make a $20,000 interest credit on the full $200,000, irrespective of the loan on the street. So how does that work? How is that possible? How could money be working in two places at once? Well, mechanically, what's occurring is essentially the insurance company is giving you a line of credit and says, you know what, Mr. Customer, Mrs. Customer, here's what we're going to do for you. Because we have this loan fully collateralized by the cash inside your life insurance policy, we're actually going to give you $100,000 out of our pockets for you to go ahead and invest as you choose, and we'll charge you a nominal interest rate of about 3 or 4%, which you can pay back to us at the end of the year if you choose to. If you choose not to, that's fine too. And the principal repayments are entirely up to you if and when they happen. So what that means is we've coined the be your own banker strategy, because again, the loan parameters are completely up to you. You can choose to repay the interest, not choose to repay the interest. We do recommend paying the interest for the health of the plan, but that's again, your choice. And as far as the principal repayments, entirely up to you if and when they occur. So how do we create this dual interest bank? Let's dig into it a little bit more. Let's maybe take a look at some of the benefits, the icing on the cake, as we've said here. Because this plan, as I mentioned earlier a few times, predates the creation of the IRS, it has a lot of really neat intrinsic tax benefits. One of those is what we call a tax-free income potential. And the reason the money comes out tax-free is because of that IRC code section 7702 that I talked about, with the corridor inside the plan that keeps the cash from taxation. So essentially what happens is, if you're familiar with the term Roth-like growth, if not, I'll go ahead and take a step back to explain it. There's two different types of tax benefits in a qualified retirement plan. A qualified retirement plan is defined as something such as a 401k, an IRA, maybe a pension account, something of that nature. All of which life insurance is not, which we're glad about due to the fact that we have less restriction on the plan. So the going back to the difference between a traditional IRA and a Roth IRA. A traditional IRA is something that would be contributed into a 401k or an IRA on a pre-tax basis, meaning that if you make $100,000 a year and you put $10,000 into a traditional IRA or a pre-tax vehicle, the IRS is only going to tax you on $90,000. So essentially what happens is that money then grows inside that vehicle for many, many years, and one day will be distributed to you in your retirement. However, it will be distributed and taxable, plus all the growth. So let's say $10,000 over 20 years has grown to $100,000. Now you're going to be paying on that full $100,000 in taxes versus the $10,000. So what I call that is taxing the seed only to reap the harvest, which the IRS loves when you do that. So what would a Roth scenario look like? You make $100,000, you put $10,000 into a Roth type vehicle, you pay the IRS the full tax on your $100,000 salary that year. However, as that $10,000 grows into $100,000 one day in your retirement years, when you take it out, it's tax-free. So what I call that is pay the tax on the seed to forgive the tax on the harvest, which the IRS does not like when we do that. However, the single most I would say largest way to contribute to Roth type vehicles, because as you know or don't know, Roth has very limited contribution ability. And if you make over a certain amount of money, you're not able to contribute to Roth. And that is, again, in my opinion, by design for the IRS's benefit, I should say. So with life insurance, like I mentioned, it emulates a Roth type benefit. So what's really neat about that is we have some clients putting millions, literally millions of dollars into life insurance to get that tax benefit. So for example, recently had a client put in $1 million into a plan. In his retirement years in tax-free income, he'll take I believe it was about $50 million in tax-free income because, again, he chose to forgive the tax on the seed or pay the tax on the seed to forgive his harvest. So he has the forward thinking of, hey, taxes could be higher in the future. Also, I'd much rather pay tax on the seed so my harvest can grow and I can have tax-free income in my retirement years. So as a kind of wrapping up this aspect or benefit of the plan, albeit in my opinion a very important benefit, if not the most important, is that you essentially are wanting to have a plan that allows you to have unlimited Roth-like contributions and growth, which the single only way to accomplish that is by using a life insurance vehicle. So I think we got that one done. So let's move on to the next benefit: speedy access to cash for investing. Literally, with these types of plans, the way that we design them, we take the surrender charge off the plan, so the client's not in golden handcuffs. We don't believe in that. We are fiduciary advisors. So what we're going to do is literally allow you to take about 85 to 90% of your initial contribution into these plans out in 1 to 2 business days. So very speedy access to capital for funds on demand for running your business, cost of living needs, or an external investment so you can take advantage of that dual interest like we learned about early on in the video. Moving on to the next benefit, although we are not maybe using this for the intrinsic benefits of the life insurance plan, it certainly is an intrinsic benefit that we should look at, and that is protection of your wealth during a personal health crisis. These insurance plans come with a myriad of other riders that benefit you during life, not just during death for your family. So let's say, for example, you have a critical illness such as cancer, heart attack, stroke, something occurs. You can advance up to $1 million tax-free for you and your family just to get the funds you need to avoid bankruptcy, maybe take a few years off of work in order to just get healthy and get better. So the critical illness, critical injury, terminal illness, or even a chronic illness would be covered in this type of scenario for protection of wealth during a health crisis. Specifically, when I refer to chronic illness, what that is kind of like your long-term care benefit, that if you can't perform 2 of your 6 daily living activities or have a cognitive impairment such as dementia, you would actually qualify for a monthly distribution from this plan that again would come to you tax-free to your family to help pay for in-home, out-of-home care, mortgage, anything you need. Essentially what the life insurance company does with these riders is they just advance the money to you, and if you want to use it for any thing that you desire, you can. They're not going to ask you what you use the money for, which is also a very nice aspect versus some of the more traditional plans where you have to prove that you're using it for qualified expenses. So again, an intrinsic benefit of having life insurance, not maybe the reason that you're attracted to the strategy, but something I just want to mention because a lot of people don't maybe realize now that insurance plans come with a lot more than just death benefit. They also have these riders that are very helpful to many of our clients who have had personal health crises in their life and want to return to normal but don't want to blow up their investments or sell off investments because they have to, if that makes sense. So moving on to the tax-free transfer of wealth to your estate and beneficiaries. I call this kind of creating a family bank. One of the really hard things to talk about in family planning is, passing on wealth to the next generation. And, obviously that has a tough conversation associated with it because we're talking about passing away. And that's a hard conversation for families to have, but an important one. And realistically, a really cool thing about life insurance, again, mentioning the predating of the IRS's creation and why life insurance has so many of these really amazing intrinsic tax benefits that you don't see with other plans, is a transfer of wealth tax-free from one generation to another. Death benefit is not taxed in this country, not on an income tax basis. So if you want to leave a legacy to the next generation, life insurance is a great way to do that. Especially knowing all of the versatility of it, knowing that you can contribute to it, then one day take income from it tax-free and still have that legacy death benefit intact for your family. So again, another intrinsic benefit of this being life insurance, but an important benefit for succession planning if that's a priority to you. The next thing I want to kind of get back into is the loan capability and how that works. There is no cap on loan size or frequency up to what you've contributed to the plan. So for example, to compare that to a 401k, as you may or may not know, you can only take one loan a year from a 401k and it cannot exceed $50,000. Well, a lot of people have more than $50,000 in a 401k and have investment needs or hardships where they need to get more capital out of their retirement plans. But again, you're kind of in those golden handcuffs with the restrictions of qualified retirement plans. With life insurance, going back to the example of the gentleman that put $1 million in a plan, the next business day, he took about $850,000 and he took it out to invest in something else. I believe it was a cryptocurrency investment he wanted to make. So realistically, because we remove the surrender charge on these plans and we don't put our clients in those golden handcuffs, you can take as many loans as you need from these plans up to what you've contributed. About 90% year one, that'll improve year over year. But we do not restrict clients from taking loans from these plans. We actually highly encourage it because we want you to take advantage of the dual interest capacity of these plans. We want your money working harder for you in two places at once, and the vehicle that allows you to do that is these loans. And again, earlier in the video we kind of went over this at some length, but the nice thing about taking loans is you are your own banker. You don't have to pay back interest or principal on any other terms but your own. And of course, we'll help guide you through that, but that's a pretty amazing benefit to kind of have control of your lending and kind of get away from these restrictive lenders that, have late penalties if you don't pay back on time, make you pay a portion of principal and interest back. This is where you kind of take control of that lending for your own personal needs. Now, a lot of people ask me, well, Holly, this all sounds great. You kind of mentioned earlier in the video that I would make a 10% return hypothetically, but how is, mechanically, how does this plan make money? Like what's growing the balance inside the plan? And so what we describe it is market-like gains without the market risk. And so what I mean by that is that you're never going to have a negative return on these plans. You actually have a floor of 3% as your earnings basement, so the minimum you can earn every year. On top of that, you don't have a cap on what you can earn. So many of our clients this year averaged, I would say, about between a 9 to 11% return this year. And reason being is mechanically, life insurance are mutual companies, which means that they do not, cater to stockholders like banks do, which are publicly traded companies. So they're most concerned about their stockholders and keeping them happy versus their customers. So with life insurance companies, they are most beholden to their policyholders. And so what they are looking to do is pass on interest earnings or dividends to their policyholders because they are mutual companies. And so essentially what life insurance companies do is they're very highly regulated in what they can invest in. Typically it's fixed instruments such as bonds, government securities, maybe some mortgage-backed debentures, things that are very stable returning vehicles. And then when they earn money in their general funds, they pass that on to you as well. So if you would like to schedule a consult to kind of learn more about that I would be happy to meet with you and just teach you a little bit more about the complexity of how that mechanically works. But just at a high level, I think the most important thing to understand about life insurance is that they are mutual companies beholden to you, their policyholders, not stock. Like a stock or a publicly traded company where they are more beholden to their stockholders. And so I think that's why life insurance has had for over 180 years the predictable returns that many customers really appreciate without the risk. And not to say that you can't take money out of these plans and put them into riskier investments, but it sure is nice to know on one side of that transaction, you've got the safety of a very predictable return and also a tax-free return. So moving on to, I think we just kind of covered this, but just I'll kind of go over it again here quickly, but there is a minimum guaranteed returns that help hedge against inflation with these plans. And that's what I was referring to when I talked about the 3% floor. And that floor will increase as inflation rises. So basically that floor at 3% today is kind of mimicking inflation. But let's say, for example, that, we've all kind of a popular topic right now, inflation, right? So if inflation does rise, we'll see that floor rise as well. So the neat thing about these plans is they are designed to be inflation sensitive because we always want you at least outpacing inflation at the minimum level of the return, albeit we know that the minimum return will be the floor of your return, and so likely you will receive much higher than that minimum return. But it is comforting to know that these plans have the forward sight to understand the importance of an investment being inflation sensitive. So moving on, exclusive tax benefits for U.S. citizens, resident aliens, and foreign citizens of non-resident aliens. Foreign citizens and non-resident aliens. So this is a little bit more of a complex aspect of the plan and very specific to what country you are from or maybe a dual citizen of or a resident alien from. But please, if you are a resident alien or a foreign citizen or a non-resident alien, highly encourage you to look at this strategy and have us help you understand those tax benefits that you may receive. A lot of people don't realize kind of the other side of the coin of residing in this country and not being a citizen is you could be subject to some dual taxation from both countries, and life insurance can really protect you and your estate from having some significant taxation. So would love to meet with you if you have that particular situation in your family. Next, let's talk a little bit about the anonymity from the IRS and creditors and predators. Again, because this plan has such favorability with the IRS does not track distributions from these plans because we actually have them coming out to you as loans. And as I always tell people, the IRS cannot, has not, and will never be able to tax or track loans. They only are going to be taxing and tracking income to folks. So that's kind of how we get you around that obstacle. Also, in many states, and it is state specific, which will help you look at, creditors and predators cannot come after life insurance. So let's say, God forbid you face a legal matter or a lawsuit, your assets can be protected in cash value life insurance. So again, that is a little bit more of a specific state by state situation, but if you'd like to schedule a consult to look at some of that intrinsic protection specific to you, life insurance does have a lot of favorability from the IRS as well as creditors and predators. Moving on, I believe this is our last topic here before I'll show you the calculator so you can play around with some numbers and see what your dual interest capacity would be. But this is also a fantastic college saving vehicle. I call it for the children of today. And the reason I say that is, 529 plans, they are good vehicles and do have some tax benefits, but realistically, really big elephant in the room on a 529 plan is, what if my child doesn't go to college? Do I really want to pay a 10% penalty to get that money back out because my child took a different path and became maybe a real estate investor or a young entrepreneur? For me, I just think that college is not always the path for everyone. And so why not have a more adaptable saving vehicle for children to where it wouldn't be a negative for them to maybe use the funds to start a business or do something different, and also teaching your children to be their own banker and have anonymity from the IRS and from banks and predatory loans and learning how to bank on themselves. And so really putting finance as a forefront in the education of children, I think, where in my opinion, I don't believe the school system really does financial education a justice. And I think that this type of a savings vehicle can really help children understand how money works and how to bank on themselves and not have the restrictive nature of, I've got to go to college, because again, that just might not be everyone's path. The other nice thing that's interesting about life insurance is that cash value life insurance actually doesn't count against your FAFSA in many cases. That, again, that is probably state specific and something we can look at. But that is also a nice thing to know as far as if your child does want to go to college and they do have savings, not being penalized for an ability to get scholarships. So that's kind of a quick version of the About Us page about earning dual interest program. I hope that you enjoyed that. If you'd like me to go over in any more detail, please feel free to contact us, and I'll be happy to schedule a consult with you and take some time. And please feel free to read through in more detail as well. Just trying to kind of give you a quick highlight of the different benefits and utility of these plans. Now let's go and move on to the fun part, where we can kind of learn how to use the dual interest calculator, which is going to teach you how to use this particular tool on the website and allow you to really see what your potential with these plans is. I'm going to use myself as an example. So I am female. I'm going to put my date of birth here, which is June 21st, 1987, first day of summer. Woohoo. And then I'm going to pick my annual contribution. So this is for the whole year. I'm going to be aggressive here, and I'm going to say, let's do $25,000 a year. I'm just going to elect here that I have not been diagnosed with a terminal illness, and then I'm going to click preview, and this is going to generate a ledger for me to review that shows my total contribution, and this is over 10 years because these plans actually can be fully paid for within 5 years, most commonly 10 though. To know that you'd have a fully paid for plan in 5 to 10 years is pretty cool. And then this here is highlighting what my tax-free distribution would be to me once I elect to start taking income to myself. In this example, we've chose a common retirement age of 65 to 85. The nice thing about these plans, though, is you can certainly take income much earlier in life or later. There's no restriction like an IRA or 401k where you have to wait to a certain age to take money out. So just to help you read this ledger real quickly, this far right-hand side here, this is showing the net death benefit year over year. This column is showing my liquidity, or my loan column, the surrender value column. This is what I can take out to put into external investments or use for cost of living needs. This column here is my accumulated value column. This is going to be the basis for the interest credit, irrespective of what's here. So, for example, if I took $100,000 out in year 5, my basis for my interest credit, although this would now say $27,000, will still be $127,000. So if I got a 10% credit, I'd make $12,700 inside the plan, even though a majority of the capital is on the street doing something else. This here is the inflow. So this is showing that $25,000 a year I elected to look at. Scrolling down into the ledger, just showing you here where I stopped after 10 years and structurally reduced down that death benefit because I'm not contributing any longer. And then if we go even further down, you see here where I start to take about an $82,000 tax-free income from me and my family in my retirement years. I do that all the way down, I believe, to age 90. Pardon me, I thought it was 85 earlier, but 90. So again, that represents that cumulative amount up here of the nearly $2 million. So I invite you to please come and check out the calculator, plug in some numbers, and when you're ready, just contact us to proceed, and we'll actually generate an official ledger for you to look at and go through it with you in detail on a screen share. Look forward to meeting you. Thank you so much for your attention, and have a great day. Thank you so much. Bye.